Hey everyone, let's jump right into this explainer. Today, we're going to completely demystify two absolutely massive accounting standards, IAS 16 and IAS 38. And we're going to do it by tracking the complete start-to-finish life cycle of business assets. Think about it. Literally every business, from your local bakery down the street to a massive global tech conglomerate, relies on assets to generate revenue. But how do we actually track these investments from the exact day they're bought to the day they're finally sold off? Well, that's exactly the story we're unraveling right now. Here is the roadmap for today's explainer. First, understanding non-current assets. Second, acquiring and tracking them. Third, depreciation, or the cost of time. Fourth, revaluation, when values change. Fifth, intangibles and amortization. And finally, number 6, asset disposal and exchanges. All right, section 1, understanding non-current assets, setting the foundation. So you know the matching principle, right? That's what really drives the core difference here. Whenever a company spends money, they have to make a choice. Is this an asset or is it just an expense? If it provides a long-term benefit, meaning more than a year, and it actually enhances the business's earning capacity, like buying a brand new delivery man, we capitalize it. It goes straight onto the balance sheet. But if it's just maintaining our current capacity, like paying for the fuel to run that van, well, that's a revenue expenditure. It gets expensed immediately on the profit and loss statement. We essentially capitalize those big ticket items so we don't just completely tank our current profit, instead matching that heavy cost against the revenue it's going to generate over time. Moving right along to section 2, acquiring and tracking assets, the birth of an asset. The thing is, you don't just record the sticker price when you buy something. Take a look at this journal entry. The machinery's base purchase price was 50,000 rupees, but the asset is actually recorded at 55,000. Why is that? Because under IAS 16, you literally have to include every necessary cost to get that asset to its location and running exactly as intended. That means the 2,000 for delivery and the 3,000 for installation? Yeah, those are capitalized directly into the asset's total value. Now, once we own it, we actually have to keep track of it. To manage all of this outside the general ledger, companies rely on a non-current asset register. You see, the general ledger really only shows the big picture numbers, like total machinery, 1 million. But the asset register, that is where the real granular details live. It tracks ID tags, physical locations, individual depreciation rates. It's essentially your ultimate internal control tool to prevent theft. Making sure that top-of-the-line company laptop doesn't just mysteriously walk out the front door. And it's the absolute foundation for calculating accurate depreciation down the line. Which brings us perfectly to section 3, depreciation, the cost of time. Before we start crunching any numbers, we really need to nail down a vital concept, net book value, or NBV. This is simply the original cost of the asset minus all the accumulated depreciation over its life so far. But listen closely to this part. NBV tells us the remaining accounting value of the asset. It is not its market value. It's definitely not what we could sell it for on the street tomorrow. It's just the unallocated cost that's still sitting there on our statement of financial position. So how do we actually calculate that drop in value? Well, we've got two main characters in this story, straight line and diminishing balance. Straight line is super simple. The value just drops evenly every single year. Think of basic office furniture. But diminishing balance applies a much heavier charge in the early years. Businesses have to choose a method based on how the asset actually behaves in the real world. Does it wear out evenly, or does it drop in value incredibly fast, kind of like a brand new company car, losing 20% of its value the absolute second it drives off the lot? Let's actually look at the math for diminishing balance. Notice how the 40% rate is applied to the declining balance each year, which gives us a really heavy expense up front. In year 1, 40% of 50,000 gives us a massive 20,000 depreciation charge. But jump to year 3, and we are only taking 40% of the remaining 18,000 balance, which comes out to just a 7,200 charge. It perfectly mirrors assets like technology that just become obsolete incredibly quickly. Okay, section 4, revaluation, when values change. Depreciation naturally assumes that value goes down over time. But what if it doesn't? What if we own a piece of land or a commercial building in a booming real estate market? It makes absolutely zero sense to keep it on our books at some super low historical cost when it's actually worth double that today. Thankfully, under IAS 16, we can use the revaluation model to bump that asset up to its fair value. But here is the major catch. We haven't actually sold the building yet, right? So we haven't realized that cash. Because of that, we store those unrealized gains safely away in an equity account called the Revaluation Surplus, which flows through other comprehensive income. We do this so we don't accidentally artificially inflate our immediate profit for the year with cash we don't actually hold in our hands. This two-step ledger process shows exactly how elegant this is in practice. Say we have a building with a net book value of $920,000, being revalued up to $1.2 million. First thing, we debit accumulated depreciation to completely wipe out the old $80,000 balance. Gone. Second, we debit the building cost account by $200,000. Together, this bumps the asset to its new $1.2 million fair value, and it all balances out by creating a nice $280,000 credit in our revaluation surplus. Pretty brilliant, isn't it? All right, moving into Section 5, Intangibles and Amortization, the invisible assets. Both of these categories are long-term assets held to generate revenue, but they honestly live in totally different worlds. Tangible assets have physical substance. You can literally touch a machine. Intangibles, no physical substance at all. They are legal rights or privileges, like software licenses, patents, or trademarks. And because you can't physically wear and tear a patent, we don't depreciate it. Instead, intangible assets are amortized, gradually expensing their cost as those legal rights expire over time. Now, creating an intangible asset from scratch inside your own company, that gets tricky. IAS 38 forces us to draw a very hard line between research and development. Research is just original investigation. It's way too uncertain if it will ever make a dime, so we expense it immediately to the profit and loss. But development, that's the actual application of those findings into a workable design. Because it's a lot closer to becoming a real product, development costs can actually be capitalized into an asset. But, of course, there's a catch. You can only capitalize development if you pass this incredibly strict 6-part test. You literally have to prove technical feasibility, your intention and ability to complete it, that it will definitely generate probable future economic benefits, that you have the resources to actually finish the job, and that you can reliably measure the costs. If you fail even one of these 6 criteria, all those development costs go straight to the expense column. No exceptions. Let's look at Technovate's software project for a quick example. They met all 6 criteria. Notice how we bundle their direct salaries, materials, and patent fees to create a 180,000 rupee intangible asset on the books. But check out that note at the bottom. 30,000 in general overheads are strictly excluded. Only the directly attributable costs get the privilege of joining the asset value. And finally, we've reached Section 6, Asset Disposal and Exchanges, the end of the line. An asset has served us well, but maybe it's completely obsolete now. Or maybe we just want to upgrade to a newer model. Whether we sell it for cold hard cash or trade it in, we absolutely have to settle the final score on our books. To figure out if we made an accounting profit or a loss on the disposal, we follow 3 super simple steps. First, calculate the depreciation right up to the exact date you get rid of it. Second, use that to find its final net book value. Third, and most importantly, compare what you got for the asset against that final NBV. If your proceeds are higher than the NBV, you've got yourself a gain. If they're lower, you're taking a loss. Let's look at how this balances out perfectly in a part exchange where we trade an old asset for a new one. XYZ books the brand new machine at its fair value of $150,000. Then we clear out the old machine's accumulated depreciation of $33,250 and its original cost of $100,000. We credit the $80,000 cash we had to pay to make up the difference. And right there at the bottom, the balancing figure reveals a neat little gain on disposal of $3,250. Out with the old, in with the new, and the profit is officially recorded. Everything we've discussed today, every single purchase, every year of depreciation, every revaluation, and every disposal, it all culminates right here in the Property, Plant, and Equipment Disclosure Note. This is the table that reconciles the opening balances to the closing balances for the financial statements. It's essentially the ultimate summary of the entire asset lifecycle. So the next time you're looking at a company's balance sheet, don't just glance at the final number. Ask yourself, what hidden stories of upgrades, wear and tear, and market booms are actually tucked away inside those carrying amounts?